Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent jobs report where the unemployment rate fell to 3.5%. We're going to discuss the likely response by the Federal Reserve and the effect it would likely have on risk assets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, there's going to be quite a bit to unpack here. And if you've been following this channel in 2022, you likely already know what I'm going to say. But again, I'm going to say it anyways because I think it's good to have repetition. It's good to understand these overarching trends in the macroverse so that we really digest them and understand how they are likely going to affect risk assets. So what I want to talk about is first, we got the most recent jobs report, okay? And we know now that the unemployment rate has actually fallen back down to 3.5%. Now, I do believe that the number of jobs that were added, there was a general expectation that it would be higher than where we actually came in. So you could argue that technically speaking, it slowed down a little bit. And that's probably what the people who have a bullish bias would say. But the other way to simply look at this is to just say, well, unemployment fell. And this is one of the most important metrics for the Federal Reserve that they're looking at to figure out if they should remain hawkish or not. And because unemployment is at a historic low once again, that likely means that the Federal Reserve has the green light to remain hawkish despite the fact that the economy has been slowing down. So throughout 2022, I've expressed many times that the Federal Reserve will be likely raising interest rates much higher than most people expect. I've always said I think they're going to make it, sort of my base case is 4 to 5%, but look, they could go higher. If inflation doesn't come down and unemployment stays low, they could go higher, and you need to be prepared for something like that. I do think they will be making it up to the 4 to 5% range before the end of this year. Now, I want to unpack a few things with the unemployment rate. So remember, this doesn't always capture everything as it truly is. Okay, I mean there's certain things that it cannot capture, and a lot of people might argue that the data can't be trusted. My counter argument is that it doesn't matter if it can't be trusted. It's what the Federal Reserve will point to as a reason to remain hawkish. Okay. If you look at where the unemployment rate is right now, so it's back down to 3.5%. This is basically on par with the lowest level of unemployment we've seen this business cycle. In fact, to find a time when the unemployment rate was lower than it is now, you would have to go back to the late 60s and early 70s. The reason why that's important is because inflation ran rampant during that time. Okay? And the other reason why that's important is because the stock market stayed flat for the better part of a decade. Now, I've said all year that I would like the Federal Reserve to remain hawkish. There are a lot of people that don't want them to remain hawkish. There's a lot of people that are hoping for the Federal Reserve to pivot. However, as I've said before, there's a lot of evidence to suggest that even when the Federal Reserve does pivot, it doesn't even mean that the bottom is in. If you look at what history shows us, normally by the time the Fed starts cutting interest rates, the stock market doesn't bottom till a ways after that, usually at the end of the rate cutting cycle. There is something that I think people should be aware of with regards to the Federal Reserve and them raising interest rates that is actually very different than what we usually see, is that normally when the Federal Reserve is raising interest rates like in 2016, 2017, 2018, and 2019, and in other periods as well, like in the early 2000s and over here in the early 90s, normally when the Federal Reserve is raising interest rates, the stock market is going up. So think about that for a minute. Normally they raise interest rates while the stock market is going up. This makes sense because you don't want things to, you don't want the economy to get too hot because that leads to high inflation. And, you sort of want to make sure there's a good balance between supply and demand. The issue now is that the stock market is coming down while the Federal Reserve is raising interest rates. But if you look back at history, once the Federal Reserve starts cutting rates, that usually occurs when they think there's signs of economic slowdown, like in 2007 and 2000. Okay, they'll start cutting rates because they sort of see what's coming. This time, they don't care. They don't care what the stock market is doing right now. Why? Well, because inflation is higher than it has been since like the early 80s. So, I've said all year, right? I've said all year. They're likely going to keep raising interest rates despite all the bulls claiming they're not and claiming they're going to pivot any day. This is just simply not the case, right? We've literally said this all year long. And with inflation now at 8.3% year over year, I mean, we will get more inflation data next week, so I think that will be useful to look at. But I would argue that with unemployment continuing to stay low, there is a really good chance that the Federal Reserve will remain hawkish because there's no clear sign yet that inflation is coming back down. In fact, the most recent inflation consensus for headline inflation year over year, we'll find out what it is on October 13th, is at 8.1%. Now, I don't know if it's going to come in under that or over that, but the more important thing that the Fed likely cares more about is core inflation. And the consensus on that is 6.5%, which is actually higher than where it was last month and would be tied with where it peaked in March. So, we've talked before about inflation and has it peaked, has it not peaked? There's always a chance that headline CPI has, but if core inflation has not yet peaked, the Federal Reserve is simply not going to like that, okay? And they will remain hawkish longer than a lot of people think they will. I don't personally think they're going to start cutting rates until next year, and I've said this, for the entire year. Okay, I think it's fairly clear. Now, how have markets responded to the most recent unemployment rate going back down to 3.5%? Well, if we go over here, we can actually just reload this to see where it currently sits. The market now says there's an 84% chance that the Federal Reserve will raise interest rates by 75 basis points at the November meeting. An 84% chance of a fourth 75 basis point rate hike. What's more interesting is that if you go to December, there's now a 23% chance that we'll have another 75 basis point rate hike, which would mean the federal funds rate could end the year at 4.75%. Now, that's not what the most likely scenario is right now. Right now, the most likely scenario is the Fed funds rate ends the year at 4.5%. But you can clearly see that markets are counting on the Federal Reserve to remain hawkish. Why will they remain hawkish? Because unemployment is coming back down. Why is that an issue? Because it contributes to, if a lot of people have jobs and there's a general expectation that inflation is going up, you'll see wage inflation as well. This continues to sort of put pressure on the Federal Reserve to cool the economy off. And look what happened to oil. Oil's back approaching $91. Why? Well, my perhaps naive interpretation and ignorant, I don't claim to be an expert at this, I'm just an armchair economist trying to look at the data, but my potentially naive interpretation is that, there's a lot of people that say we're already in a recession. And again, I understand the academic argument for that. Real GDP, negative 2 quarters in a row, that's usually a fairly good argument. But the other argument is that we don't normally go into a recession, the gray shaded regions, until unemployment starts to go up, but it's not going up yet. So we're not, by this definition of unemployment really starting to move higher, or the inversion of the 3-month and the 10-year yield, we're not yet in a recession, according to this. Now we're in maybe a technical recession based on negative GDP, but based on the unemployment level going up, we're actually not in a recession yet. But the Federal Reserve is trying to accomplish it would likely seem that they're trying to accomplish this, right? They're trying to cool off the labor market. They would like to see the softening of labor market conditions. And what you're likely going to hear Powell say at the November meeting is that the job market still remains strong and they still haven't seen any softening of labor market conditions. He said this all year, and he'll likely allude to the same thing. Now, he might say that the total number of jobs added came in less than what was expected, but he'll also likely talk about how unemployment remains relatively low and that inflation is going to continue to be their main issue that they want to get back under control. So let's recap here. Unemployment came in, it's back down to 3.5%. Inflation is still coming in at 8.3% year over year. We will get new data in the next week. So on October 13th, we'll get more data on that, and we'll figure out, is core inflation slowing down? Is it accelerating? Is headline inflation slowing down? Is it accelerating? The fact that oil is going back up is likely going to renew at least some fears that inflation could come roaring back. Remember, I mean, it did in the 70s. You can see it. You could easily see inflation be a bit more sticky. Maybe it comes down in a stochastic manner rather than in a linear manner. That's something that we have to consider. Nothing goes down monotonically usually, just like things don't go up monotonically. So, if unemployment is still at historic lows, if inflation is still at relatively historic highs, the stock market is coming down. It's true. And normally, when you see the stock market coming down, the Fed cuts rates. But this time, they don't have the luxury to do that. Why? Because inflation is high. That likely means that the Federal Reserve will remain hawkish for some time to come, likely going to continue raising interest rates. We'll likely see another 75 basis point rate hike in November. We might even see another one in December, although the most likely scenario right now in December is a 50 basis point rate hike. And I mean, you can see as we go out to, say, February and then March of 2023, markets are starting to price in interest rates potentially over 5%. By May, there's a 5% chance that the federal funds rate could be 5.25%. And I think this is something that we really need to take seriously. We've said for the entire year, don't fight the Fed. Doesn't mean that you can't have occasional rallies in risk assets. It certainly doesn't. But what it does mean is that there is a bias for risk assets to still remain weak as long as the Federal Reserve remains hawkish, and they can remain hawkish as long as inflation stays high and unemployment stays low. I don't think there's going to be any serious change to anything until one of these gives. Either unemployment needs to go up or inflation needs to come down. What I'm hoping for is I'm hoping that inflation will come down before unemployment goes up. That's what I would like to see. Because if that happens, then the Federal Reserve could theoretically pivot at some point, even if the unemployment rate isn't going to, 5 or 6%, right? They could pivot at that point. And maybe unemployment hasn't reached those higher levels. But the problem is that that inflation is still remaining relatively sticky right now. It's not coming down very quickly. And so we have to take this into consideration, that risk assets do remain very risky. The other thing I'd like to point out is, if you go back, and I did a video on this the other day, so if you want to see the full video, make sure you go look at that. But if you compare this bear market to the one in the 70s, there are some similarities. Now, arguably, there's also similarities between this one and, say, the financial crisis in '08, right? Some similarities there. But if you want to compare to a period of high inflation like in the 70s, you'll see that we had a leg down, we went sideways for a while, and then we ultimately had another leg down. And this leg down over here could come if the Federal Reserve goes too far with raising interest rates, right? So if they go too far, and I do think it is it's a likely, there's a high risk that it's going to actually happen. What do I mean by that? Well, arguably, interest rates, the Federal Reserve becoming too hawkish is what pushes us into a recession. You can see that, they raised interest rates over here and it pushes into a recession, arguably, right? I mean, it's a lot more complicated than that. And I'm not saying that the Federal Reserve raising interest rates is the only reason, but it certainly does have some effect. So if the Federal Reserve gets, if they go too far with their federal funds rate, it can actually push the economy back into a recession. You see it time and time again. So this is the argument. If they raise interest rates too far, they could push us into a fairly deep recession like we've previously seen. And if that happens, the reason why it will be declared a recession is not because of negative GDP. It will likely be because unemployment is going up. And that's what they care about. Okay, that's what they care about. So if you go back and look at this 1970s bear market, you can see that it had a leg down. We went sideways for a while, and then we had another leg down. So you might argue, and if we go back to, say, 1973 to 1974 on say the inflation chart. So we'll go back to 1973, 1974. It was this one right here, right? It was in this area. So my thinking right now is that it makes sense to be cautious. It makes sense to play defense. It makes sense to assume that rallies are nothing more than counter trend rallies, bear market rallies until proven otherwise. I don't think there's any reason to assume just yet that the stock market has put in a major bottom. I mean, I've said that for a long time. We even said that throughout the summer, even after the June low, right? After the June low, the stock market has now gone lower. And I think it makes sense to assume that the status quo will remain unchanged. You may notice that the stock market tends to bottom, except with with the exception of 2001, the stock market tends to bottom during the recession, right? During the recession. That's when it usually bottoms. Not after it, but during the recession. But we don't normally have a recession until unemployment goes up. Unemployment hasn't even started going up yet. You've probably heard the Federal Reserve allude to the idea of engineering a soft landing. What does that mean? Well, the idea is that they could just keep raising interest rates and remaining hawkish, rolling off assets from their balance sheet without actually pushing us into a full-blown recession. And by the way, they would likely define that again as unemployment really starting to go higher. If inflation comes down and unemployment doesn't go up, then you could argue they've achieved a soft landing. The problem is it's sort of like the chicken and the egg. The problem is that the only way that one of the main ways that you would see inflation come back down is if the unemployment rate goes up, right? If there's there's pressure or there's a lot of people that just don't feel compelled to spend their money anymore because of certain circumstances, like they don't have a job or they're worried they're going to lose their job. These things are very difficult on people, but to some degree, you could argue that the Federal Reserve is trying to accomplish this to some degree so that they can actually get inflation back down, and then we can hopefully head back into another sustained period of economic expansion at some point. I mean, at some point, they'll likely turn the money printers back on, but we cannot assume that they're going to do that while inflation remains high and the unemployment rate remains low. I know there's been a lot of information in this video, and I'm sure that I rambled maybe just a little bit, but hopefully you guys enjoyed it. And we'll continue to follow this very closely. I think the next time we should probably do a full-fledged video like this will be next week when we get inflation data. Because if inflation can come down some, then it would at least be somewhat optimistic, right? But I still think that there's going to be some pain to come for a while. So this is sort of where I stand. I know it's something that a lot of people might not like or agree with, but I just have to go with the charts, have to go with what the history tells us about these certain circumstances, and I'll just stick with that. So do remember, if you guys like the content, make sure you subscribe. Again, I do appreciate you subscribing. Please give the video a thumbs up. You can click the bell icon to turn on notifications, and we will continue to go through all these charts. And again, if you want access to all these charts, as well as all the Cryptoverse charts that I show and stocks, go to intothecryptoverse.com. Thank you guys for tuning in. Subscribe. I'll see you next time. Bye.